Hi everyone, this is Victor here. Taiwan Semiconductor Manufacturing Company, or TSMC, is the world's largest pure-play semiconductor foundry. At the time of recording this video, TSMC stock is down 40% from the most recent peak. Many investors want to know, is TSMC stock undervalued now, and is TSMC a great company for long-term investing? I'm going to answer these questions by talking about these topics in this video. TSMC stock's biggest risk you must know. You will learn about why TSMC stock is down 40% from the most recent peak, TSMC's economic moat and long-term growth prospects, TSMC stock valuation, and why buy TSMC stock. If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock analysis and investing videos a week that will help you become a great investor. Also, if you like this channel and want to support it, check out my Patreon blog in the video description and become a premium member. Our goal is to create the best intelligent investor community that will help all our members grow their stock portfolios to over 7 figures over time. With your support, we'll be able to stay independent, hire other outstanding analysts to cover different stocks, and create many excellent stock analysis and investing videos a week that will help you become a great investor. The link is in the video description. Take a look, let's start. Before investing in any stocks, I believe it is important to understand the major risks as well as the company's long-term prospects first. I want to address the elephant in the room and talk about TSMC's biggest risks first. You may wonder why TSMC stock is down 40% from the most recent peak, even though the company's revenue has been growing consistently at high double-digit rates in recent quarters. For example, TSMC's revenue has been growing over 30% year over year every month in 2022. This growth rate is much higher than TSMC's historical revenue growth rates. For example, in the past 10 years, TSMC's revenue grew at a compound annual growth rate of 15% each year. According to TSMC's latest quarter here, TSMC's revenue grew 36% year over year. Its gross margin was 55.6%, which is the highest in the industry, and its operating margin was 45.6%, which is much higher than other competitors. During this same period, even though TSMC's fundamentals have not changed, the stock is down 40% from the most recent peak. There are several major reasons. The biggest reason is that the market is worried that China may invade Taiwan in the future. If China invades Taiwan, China will likely nationalize or have majority control over TSMC because TSMC has the most leading-edge process node technologies in the world, and because TSMC controls more than 50% of the global foundry market. This is very similar to how China has control over many public traded companies in Hong Kong and China because of national security concerns. Here's the important part. TSMC is one of the most important companies in the world because it makes the most leading-edge process node technologies, such as 7nm, 5nm, 3nm, and 2nm process nodes. Many companies, including tech companies and automakers, rely on TSMC to manufacture their semiconductor chips. For example, according to this article here, TSMC's largest customers include Apple, MediaTek, AMD, Qualcomm, Broadcom, Nvidia, and even Intel. TSMC's biggest risk is the geopolitical risk between China and Taiwan. Right after Russia invaded Ukraine, the market became even more worried that China may invade Taiwan in the future. Personally, I cannot predict whether or not this will happen. To reduce risk, I believe it is important not to over-concentrate on TSMC going forward, even though the company is slightly undervalued after the stock has dropped 40% from the most recent peak. Another biggest risk or elephant in the room is this. Many investors believe that Intel may catch up to or surpass TSMC's process node technologies by the end of 2025. This is a very good summary from CNET. After years of trouble and delay, Intel's chip-making business finally has some good news to report. The most advanced manufacturing process the company has committed to will arrive in the second half of 2024, 6 months earlier than planned. Intel fell behind rivals Taiwan Semiconductor Manufacturing Company (TSMC) and Samsung because of problems modernizing its manufacturing, and it convinced chip designer Pat Gelsinger to return to the company as chief executive in 2021. Shortly afterward, Intel laid out a roadmap that meant 5 improvements to its manufacturing processes in 4 years, with manufacturing processes named Intel 7, Intel 4, Intel 3, Intel 28, and Intel 18A. Each step improves a chip's performance relative to its power consumption. Those steps are the foundation of a plan to catch up to rivals in 2024 and surpass them in 2025. If successful, Gelsinger's plan will help Windows PCs keep up with ever more powerful Macs, return Intel to its glory days at the vanguard of the semiconductor business, justify its tens of billions of dollars of expenditures, and slow the shift of chip manufacturing from the US to Asia. Intel was slower than rivals to move to chip-making equipment that uses extreme ultraviolet light to inscribe smaller circuitry elements on chips, a technology called photolithography. That's a key part of processor miniaturization. Under Gelsinger, Intel is trying to play nicer with chip fabrication equipment makers like Dutch ASML. Indeed, Intel will receive ASML's first model of a second generation of EUV machines, using an approach called high numeric aperture that inscribes finer lines than conventional EUV. Recently, TSMC announced that its leading-edge N2 process node or 2nm process node will enter volume production by the end of 2025. TSMC's N2 process node will compete directly with Intel's most leading-edge 18A process node. According to Intel CEO Pat Gelsinger, Intel's leading-edge 18A process node is around 6 months ahead of schedule and is expected to be in production by late 2024. Now, this assumes Intel will have perfect executions going forward without any delays to release 4 new nodes between now and 2024. In my opinion, Intel's aggressive process node roadmap, releasing 4 new process nodes between now and 2024, is extremely hard to pull off. If Intel can pull off volume production in its 18A node by the end of 2024, then Intel's node technologies may surpass TSMC's node technologies by 2025. It's too early to tell whether this will happen. In comparison, TSMC is expected to mass produce its N2 node by the end of 2025, and Samsung expects that it will produce its equivalent 2nm chip by 2025. Going forward, there will be more competition between TSMC, Samsung, and Intel. They are the 3 largest semiconductor companies in the world. At the time of making this video, TSMC is the world's largest pure-play semiconductor foundry with a 54% market share. Samsung Foundry is the second largest semiconductor foundry with a 15% market share. All the biggest fabless companies such as Apple, AMD, and Nvidia rely on TSMC and Samsung Foundry to make the most leading-edge chips. Intel only recently started its foundry business to compete with TSMC and Samsung's foundry business. In my opinion, even if Intel is ahead of schedule to produce its 18A node by the end of 2024, Intel will not have the same chip capacities as TSMC and Samsung. Most companies such as Apple, AMD, and Nvidia will still rely on TSMC and Samsung Foundry to make the most leading-edge chips because TSMC and Samsung have the most wafer capacities. There are other risks such as high inflation and material costs, chip shortage, supply chain issues around the world, US Fed's monetary policy tightening, and suppliers having problems delivering chip-making tools to TSMC. Many of these issues are outside of TSMC's control. High inflation cost is one of the biggest issues for the entire chip-making industry. In recent years, TSMC has increased its prices multiple times to offset higher inflation costs and to pay for fab expansion. TSMC can often pass higher inflation costs to its customers, such as Apple, Nvidia, and AMD, because TSMC has the most leading-edge node technologies and the biggest wafer capacities compared to other competitors. When it comes to investing, we have to be forward-looking, so let's go over TSMC's economic moat and long-term growth prospects. According to Morningstar, TSMC has a wide economic moat because TSMC has a huge cost advantage over competitors, and because TSMC has many intangible assets, such as its leading-edge node technologies, ranging from N5 nodes to its upcoming N3 nodes and N2 node. This is from Anitech. It explains TSMC's biggest competitive advantage. TSMC's success in the last 20 years or so was largely conditioned by the company's ability to offer new manufacturing technologies with power, performance, and area PPA improvements every year and introduce a brand new node every 18 to 24 months while maintaining predictably high yields. At the time of making this video, all the major tech companies that design chips such as Apple, Nvidia, AMD, Qualcomm, and Broadcom rely on TSMC to manufacture their leading-edge chips. For example, the upcoming iPhone 14 Pro's A16 Bionic chip is expected to be manufactured using TSMC's 5nm process or N5P process node. Based on what I know, Samsung Foundry is the only company that can compete with TSMC's foundry business. Most companies still choose TSMC over Samsung Foundry because of TSMC's node technologies, wafer capacities, and yields, as well as pricing. This is why TSMC has over 50% market share in the global foundry market. In comparison, Samsung's market share is much smaller. The barriers to entry to the semiconductor foundry industry are extremely high. It's nearly impossible for new companies to compete with TSMC and Samsung in the pure-play semiconductor foundry business, especially in the most leading-edge process nodes. This is because starting a semiconductor foundry business is very capital-intensive and it requires billions of investments every year. For example, the EUV lithography system used for chip making would cost $150 million each. The newest high-end EUV lithography machine would cost over $300 million each. Most companies cannot afford to buy these leading-edge EUV lithography machines. Only a few companies such as TSMC, Samsung, and Intel can afford to build their own foundries and buy DUV and EUV lithography machines. Another example is this. It shows that starting a chip-making business is very capital-intensive. According to CNBC, the world's largest contract chip maker, TSMC, has committed to investing $100 billion over 3 years to ramp up production. Rival Intel announced last March that it plans to spend $20 million on 2 new chip plants in Arizona. In terms of long-term prospects, I believe TSMC has several secular trends that will drive TSMC's long-term growth going forward. Right now, if you look at this revenue by process technology here, you can see TSMC's revenues come from these node technologies here. In the most recent quarter, 50% of TSMC's revenues came from 5nm and 7nm node technologies. Once TSMC releases its N3 and N2 process nodes, these new nodes will eventually become large revenue drivers for TSMC because all the major tech companies such as Apple, Nvidia, AMD, Qualcomm, Broadcom, and even Intel need these new process nodes to make their chips more powerful and more power efficient. If you look at revenue by platform here, you can see TSMC has 6 major platforms: smartphone, high-performance computing HPC, Internet of Things IoT, automotive, digital consumer electronics DCE, and others. In the most recent quarter here, high-performance computing and smartphone platforms contributed 81% of TSMC's total revenues. In my opinion, I believe high-performance computing HPC and automotive will be the biggest growth drivers for TSMC for the next 10 years because there's an enormous demand for high-performance computing products such as CPUs, APUs, GPUs, data center processors and accelerators, and high-speed networking chips. Right now, there's also an enormous demand for chips that are used in electric vehicles. Electric vehicles use many more advanced chips than traditional cars. Autonomous driving vehicles will eventually become the norm. This is why you can see high-performance computing and automotive platforms had the highest growth rates compared to other platforms in the most recent quarter here. I expect TSMC's smartphone platform growth will be very low going forward because the smartphone industry is much more mature compared to before. This is from the most recent earnings call. It shows that there's a large structural increase in semiconductor demand mainly from 5G and AI applications, high-performance computing, and automotive such as electric vehicles. On the demand side, despite the recent macro-related uncertainties, we continue to observe the structural increase in long-term semiconductor demand underpinned by the industry's mega trend of 5G and HPC related applications. This multi-year megatrend will support modest device unit volume growth and, much more importantly, drive substantial semiconductor content enrichment in many end devices across HPC, smartphone, automotive, and IoT applications. With our technology leadership, TSMC is well positioned to capture the strong structural demand for our advanced and specialty technologies, and we expect our capacity to remain tight throughout 2022. 2022 will be another strong growth year for TSMC, and we expect our full year growth to likely be or exceed the high end of our guidance range of mid to high 20% in US dollar terms. In fact, we expect our high performance computing HPC platform to be TSMC's strongest growing platform in 2022 and the largest contributor to our growth, fueled by the structural megatrend driving increasing need for greater computation power and energy efficient computing. More importantly, the increasing silicon content in end devices such as 5G smartphones, PCs, servers, networking, and automotive applications are a much more important factor in supporting our strong semiconductor demand, and with our industry-leading technology, we are well positioned to capture all the opportunities. According to Bloomberg, TSMC expects its revenue will grow about 30% in 2022, despite many global macroeconomic uncertainties such as high inflation, supply chain issues, COVID-19 lockdowns in China, and the war in Ukraine. In the past 10 years, you can see TSMC had very consistent revenue growth, operating income growth, diluted earnings per share growth, and operating cash flow growth. In the past 3 years, TSMC's revenue grew at a compound annual growth rate CAGR of 20%, and its operating income grew at a CAGR of 27%. Over the next 5 years, I expect TSMC will have very similar revenue and operating income growth rates because of the growth drivers and the large demand for semiconductor chips I talked about earlier. I want to show you how to calculate TSMC stocks intrinsic value here, so you will know whether TSMC stock is currently undervalued, fairly valued, or overvalued. If you want this calculator, you can download it in my Patreon blog in the video description. These are the key assumptions in this calculator. First, I define TSMC's intrinsic value as its future free cash flows discounted to the present day. The discount rate is around 10%. This is slightly higher than the 9.3% cost of equity from Finbox.com. You can use a higher discount rate here if you want to be more conservative. TSMC's most recent 12 months of free cash flow is 403 billion in Taiwan dollars or 13.58 billion USD. Based on the major risk and the long-term growth drivers I talked about earlier, I expect TSMC's free cash flow will grow at a compound annual growth rate CAGR between 15% and 25% over the next 5 years. To calculate the terminal value at the end of year 5, we're using both the perpetual growth and exit multiple models here. Then we take the average of both models to calculate the terminal value. We will go over these 3 case scenarios here: worst case, normal case, and best case scenarios. Under the worst case scenario, we're using compound annual growth rate CAGR of 15% over the next 5 years. If we forecast TSMC's free cash flow for the next 5 years, and discount the free cash flow to the present day, TSMC's intrinsic value should be around 444 billion for the entire company, or $86 per share. I'm giving this scenario a 25% probability here. Under the normal case scenario, we're using compound annual growth rate CAGR of 20% over the next 5 years. If we forecast TSMC's free cash flow for the next 5 years and discount the free cash flow to the present day, TSMC's intrinsic value should be around 546 billion for the entire company, or $105 per share. I'm giving this scenario a 50% probability here. Under the best case scenario, we're using a compound annual growth rate CAGR of 25% over the next 5 years. If we forecast TSMC's free cash flow for the next 5 years and discount the free cash flow to the present day, TSMC's intrinsic value should be around 665 billion for the entire company, or $128 per share. I'm giving this scenario a 25% probability here. If we add all these numbers here, TSMC's intrinsic value should be around $106 per share. This means I believe TSMC is undervalued by around 20% at the time of making this video. In comparison, Morningstar has given a much higher fair valuation for TSMC. Morningstar has valued TSMC at $171 per share. This means TSMC stock is likely substantially undervalued at the time of making this video. So will I buy TSMC stock? My answer is it depends. Personally, I already have TSMC stock in my growth stock portfolio here. It's down 27% at the time of making this video. I'm actually not worried about it because I believe it will recover quickly once the US inflation starts decreasing and once the US Fed starts slowing down its interest rate hikes. I believe TSMC's biggest risk is the geopolitical risk between China and Taiwan. To reduce risk, I will not buy more TSMC shares anytime soon because I want to limit my exposure to TSMC. This is in case China invades Taiwan. Personally, I cannot predict whether or not this will happen. However, if I don't have any TSMC shares, I will buy TSMC for the long term. This is because I like TSMC's large economic moat, its leading edge process node technologies, its long-term growth prospects in high-performance computing and automotive platforms, and its near monopoly in the semiconductor foundry industry. Based on my estimate, I believe TSMC stock's intrinsic value is around $106 per share. This assumes TSMC's free cash flow will grow between 15% and 25% each year over the next 5 years. I will update TSMC intrinsic value every quarter in my Patreon blog. If you want the latest intrinsic value update, you can download it in my Patreon blog in the video description. Now, all these are only my opinions and my analysis based on my research. They are not financial wise. There are always risks associated with investing. It's important to always invest in what you know and not speculate. You will need to do your own research and do your extra due diligence first before investing in anything. Thank you for watching this video and supporting our channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.